when we looked at the world of term insurance, you really had three components of places that a premium went, right? We had the statutory requirements that the state sets forward. So we had a little bit of everyone's premium going in this big account. Then we had some sort of underwriting mortality expenses, and then we had administrative costs. And that was really term insurance. And so it's pretty straightforward to that end. But once we get into permanent insurance products, that would be, by my definition, insurance products where the consumer has a cash value element in the policy, an element that accrues wealth over time, things change. And so in the next set of videos we're going to look at, we're going to diagram a universal life policy. And I want to start here because I can show you all the little components of universal life. And then when we talk about other types of permanent insurance, are kind of variations on that. All right, so we're going to kind of start with UL in this conversation. So the very first question that you may have is, all right, universal life is a lot more expensive than term insurance. Yeah, it is. And you say, well, is it worth it? Well, I think that's the wrong question. I think the question really should be, do I have a temporary need that I can do with something like a term policy, or do I have a need that's going to be there 10, 20, 30, 40, 50 years from now? In that case, maybe these permanent products work better. So let's talk about how the premium gets allocated here. So we'll start with that. Okay, you still have statutory reserves, and those are reserves that the insurance company is required to put aside by the state. And so the statutory reserves on a permanent product vary quite a bit, but the general idea is this product, we're going to estimate it is here for a longer time than term. So we might put a little more statutory reserves in this type of policy because we assume perhaps more future value payout, right? More likely to die with the policy than with term, where you very well might not. Then you've got the same insurance charges up front, cost of insurance and mortality margins that the insurance company builds in. Then you've got what we refer to as an expense load, and that would be any commission we pay to the sales force, underwriting cost, and built-in profit. We can make sure that these are profitable for the company, and administrative costs. But lastly, you have a fourth component now, and that component is called cash value. And so cash value kicks in. So one example, if you had a 25-year-old male in good health, preferred underwriting, non-smoker with parents in 2025, so with the term policies, I'd priced out anywhere between $250 and $425 based on how long the term was. With universal life, I priced out $1,400. Now, difference here is in a universal life world, that $1,400 is going to be the premium every year from the day to day until you're 99. That $1,400 is the deal. Okay, so it doesn't go up. So yes, it's more upfront, but it also is going to be there a longer time. So you break down what that may look like into these four buckets. And so if you had $1,400, you could say, okay, well, we're going to have some go in that statutory reserve bucket and maybe a bigger percentage than term, right? Because we're going to assume that at 25, you'll still have this policy maybe at 75 or 85, right? So put a little more in there. Then you've got your insurance charges, which aren't going to change too much from a term policy because this person still has the same chance of probability of dying in this year. And so the actual cost of insurance be about $100. Then you've got what we call the expense load. And so that expense load is going to be the what pays the administrative of all this policy getting set up. And then, yeah, some of it will go to the cash value that the consumer gets. So that first year, you're writing a check for $1,400. You see your insurance statement and it says $330. And you're like, what happened to the rest of it? Well, that's what happened to the rest of it. $280 goes into the insurance company general reserve account. $100 gets set aside for mortality risk and underwriting. $690 gets paid out, and very well may have gone a lot of that to a commission to the agent that sold it. Some of it very well could just be paying the administrative piece if you bought it online. It's kind of built into the app and the brokerage and all those costs. And then what's left does go into the cash value. So we'll kind of stop there on this video, and we'll talk a little more about cash value here in just a minute.